Howdy, Jacob here. Today we're looking at Arcadium Lithium in the chemicals industry, 4.1 billion market cap, slightly higher enterprise value. They engage in the production of lithium chemical products globally. They offer battery grade lithium hydroxide, all that other jazz. Okay, for EVs, electronics, agriculture. Okay, so pretty wide use. Based out of Ireland, founded in 1944. It's been around for quite some time. Growth is very, very impressive over the last 6 years or so. Dropped a little bit pre-COVID, but then have been exploding recently, and that's the same story for their gross and operating margin as well. Operating margin 40%. It looks like almost all their cost is cost of goods sold. Doesn't really take much beyond that. They don't have a lot of sales in general. It's really just the products or the commodities or items to create the product and batteries at this point. Very good return on invested capital. It's just tough because three of the most four recent years is not quite as good, but we'll still give it a go. So yeah, like I said, sales general admin, pretty much nothing in comparison to cost of goods sold. R&D is again pretty much nothing in relation to revenue. So not really much from that perspective, but I mean, I guess it is a lithium battery company for the most part. So I guess that's not terribly surprising. Increase of shares is pretty heavy. I'm a little bit surprised by that. Balance sheet shows 189 million cash on hand, no short-term debt, 242 million long-term debt. So almost enough cash to pay off that long-term liability. I don't think we're concerned about their balance sheet. Free cash flow statement shows a very big influx of capital expenditures. And again, the last 3 years outside of the most recent year is pretty poor. But this could just be they're just trying to grow an immense amount. I'm thinking about Amazon and something like Intel, where they're really just building factories or building warehouses to make sure growth for the future is there, and that could be what they're doing here. Maybe they're building factories to create these batteries or lithium items for computers or EVs and such. And so a little bit is through acquisition. We see that when you buy companies, you just gain on their capital, like capex as well. But it still looks like they're definitely reinvesting in themselves through capital expenditures. Otherwise, use of cash, I don't really see much here. Looks like in 2018 they paid a dividend, but then issued shares in 2018 and 2021 as well. So, not a whole lot of what I'm seeing in use of free cash flow. I mean, again, the last three of the last 4 years they didn't make money, so that's no surprise. But we'll we'll have to take that in consideration when making our assumptions. So, I mean, I'm always on the conservative end here. The company's been around since 1944 and they only have 813 million in revenue. Why is it so high recently? I mean, the EV popularity is obviously a big thing, but can they keep that going is something that I'm just a little skeptical of. I feel like I might be way too conservative here, but if I do 5%, they don't have much debt, great return on invested capital, a 17 there, because I don't think EVs are going away anytime soon. So I feel like even at the end of 5 years or 7 years, they might even have more growth than they do today, because they're still an extremely small company in relation to all the products sold that they're a part of. So the average margins here, I don't like that free cash flow is so much lower. So I'll do a little bit of a range here with, I mean, stock risk compensation is $8 million. It's really nothing. So let's just keep it flat. And here, I mean, again, I could be being extremely conservative on this revenue growth figure. If you're confident this business might grow 10, 15% over the next 7 years. I mean, this could be a way more attractive buy than what I'm saying. I do like the return on invested capital. I do think there's a premium for that. And for me right now, I just don't know enough about the business. But I do think that if you understand this business and you're confident of double digit growth, I can easily see how this could be a very solid buy at this price and just waiting for EVs to be a lot more of the market than they are today. So right now, let's see, what percent of vehicles sold per year are electric? So we see that about 6.8% of new vehicle sales are electric. That means there's a lot of room to grow here. So again, I could be being conservative. If you understand this business really well, I'd do some more research. For me personally, I don't like to do more research until the company's the company looks like a screaming buy. And for me, at these prices, I just don't think it's a screaming buy. But again, I just don't have a great understanding of this business. But either way, I hope you enjoy the video and have a great rest of your day. Thank you.